everyone, and welcome back to the Oil and Gas Rundown live here at King Operating. My name is Rachel Griffith. I'm a Senior Vice President here, and we are thankful that you're joining us again today live. Make sure that you comment below wherever you're watching this from. If you're on LinkedIn or YouTube, we would love to hear from you. Type us a question, throw a comment down there, and definitely make sure to go over to kingoperating.com and check us out there. You can learn more about our opportunities in oil and gas. And today we have with us our founder and CEO, Jay Young. Jay, you over there?
I'm here. How you doing, Rachel?
Awesome. Doing great. Thank you. And then, of course, our land and business development man, that is Bill Phillips. Hey, Bill.
Hey, guys. How are y'all?
And, of course, our EVP of Geology, Mark Ayers. Hey, Mark.
Well, hello.
Well, thank you, gentlemen, for joining me again live today. And we're going to start off, Jay, but just talking a little bit about, one of the bigger stories in the news, which is a little bit of the volatility surrounding, oil prices. Of course, there's some negotiations over the Strait of Hormuz, and oil fell approximately 5% Tuesday, then moved higher Wednesday as markets, weighed in on optimism and then risk and all that, just up and down as we've really been seeing over the months since March. So, Jay, what is kind of going on with oil prices? Why are we seeing these sudden and sharp moves right now?
Yeah, and Rachel, before I talk, maybe I need to look at the price of oil just to make sure it hasn't dived in one. No, it's down 67 cents. Okay. So, because
minute by minute.
You never know. I mean, literally, you never know right now. I mean, what you do know is that there is going to be uncertainty with this. And as long as we have a war, as long as the war is going on, we are going to have uncertainty. We don't know what the price of oil is going to be. You don't know that, but what you do know, like I said, is you're going to have some volatility with that. And because right now I feel like that even if we are, I don't want to say getting ready to be over, because I read something, I was reading one of the oil and gas reports a couple days ago, and it marked every time that we had talked about, okay, we've made an agreement, and then all of a sudden the price, they start bombing the dates of all the different agreements that we've made with Iran and all the failed attempts, and the price of oil during all this time, it is because you need 100 million barrels a day in the world every day. 20% of that goes through the Strait of Hormuz. They're bombing in south of the Saudi Arabia and the Red Sea. There's so much uncertainty. There's so much bombing going on. I don't know how the price has stayed even at the current levels, like $80, because it should be a lot higher because of all that. Because any type of shortage anywhere at all, you're going to see prices go up or down based on the global, not necessarily the United States, which we can talk about the United States and the production here in the United States, but prices do go up and down based on global supply and demand, not necessarily just the United States.
Mm-hmm. What do you think it looks like? I mean, if we actually do, get an agreement to reopen the strait, I mean, we're getting a little bit closer. What do you think that actually looks like if a credible agreement is actually put in place for oil prices, crude prices, gasoline prices? What do you think?
Yeah, good question. And, I mean, prices will come down. I think they will come down. Somebody said that they could go down to $30 to $40 a barrel with a total agreement. And I don't know if I could agree with that or not, but I do know one thing. When prices, let's say price does go down to $30 a barrel or 40, then everybody's going to stop drilling because the economics aren't there. Because of where the United States has been incredible the last 15 years is, Ken Hirsch said it best. He started NGP in the late 80s with Richard Rainwater, but he said it best on a podcast that I listened to, and it's about the price of oil and what's going on. And he said, I'm most proud of, he put billions and billions of dollars to work with entrepreneurs in the shale, which is the SHALE. And we used to get stuck in that. We used to go through it trying to get to the Ellenberger in Parker County. We'd get stuck in that Barnett Shale trying to go through it. but they started going horizontal in it, and they started drilling horizontal wells, gas wells. That has increased production in the United States from 6-7 million to 13 million barrels a day overnight, all because of horizontal drilling, fracking, and so forth. So we have a lot of production here in the United States, and because of that, we have a huge supply for us. Between us and China and Mexico, we're pretty. I don't say we're not independent, and we do not have enough oil. We are a net exporter, but it's not what you think. It isn't, because like Iran, Iraq, those countries are a net exporter. Canada's a net exporter, meaning because they produce so much oil that they only need, like Iran or Iraq, I can't remember which one, it produces like 3.5 million barrels a day. The country only uses 1 million. Well, they export 2.5 million barrels. Now, that's a net exporter to me. The United States produces 13 million. We use over 20. So by and large, 13 minus 20, we're still 7 million barrels in the hole here in the United States. But we do export a lot of our oil because we can't recycle it. So all those numbers are crazy. But the good news is we have a lot of refineries that we can go to, and we export oil and get refined, and it comes back to us. And Venezuela, I hope in the next 6 months to a year, is going to start kicking off. We could use that 2, 3, 4 million barrels a day. I don't know. We've been in agreements with them, and now we're not right now. And that's only because of the government. And, we're to drill with the government. And the government doesn't want us to drill in their top tier 1 acreage. And they can't decide on how much royalty they want, because in the United States, we have our own royalty owners, which is individuals, farmers, ranchers, and so forth. But in these foreign countries, the government owns the minerals. It's a lot different. I learned that from Bill Phillips. But it's a lot different about what happens overseas compared to here. And so they can't make a deal. Public companies, Conoco's gotten, they lost several $1 billion. Exxon's lost, several billion twice. And we just can't make a deal with them. The big thing is, if we're going to put money into that country and start developing oil and gas assets and start producing and selling oil, we want to get paid for it. If I'm Exxon, if I'm the CEO of Exxon and I say, hey, I want to spend $2 billion putting in infrastructure, and every month when we sell oil, I want to get paid, it's like the United States. That's exactly what happens in the United States. In a foreign country, the government gets the money. And when that government gets the money, then they don't give it back. And that's what happened with Exxon before. So it's kind of like mess with me once or twice or whatever. And Exxon's not too incredibly excited about that. But if we did have if we had production and everything was fine, I think we would be at the back to the 60 to 80 a year, because I don't believe price will go down to 30 to 40. People will stop rigs immediately with that news, and our production would go down a lot. Supply would go down. Our demand. What I look for here is I look for demand, and I don't see where demand is going to go down anytime soon. I think demand is going to stay strong. I don't see, as long as the population increases in the United States, the barrel per person has increased and the population has increased. Therefore, it's going to take a lot for that demand to go away or to decrease so much that we don't need oil anymore. So I know it's kind of a long answer to your question.
Oh, it's good. Did you happen to take a look at the latest EIA report?
Yeah.
I know there's some stats in front of us. I wanted to kind of get your opinion on what you take from that. What stood out to you, especially as we're talking about supply and demand. Kind of some interesting numbers.
Well, yeah, you see the crude oil or crude inventory numbers here and seeing what that is. And of course, we've drained our strategic reserves, or not drained it, but we don't have a lot of our strategic reserves right now. And that really does make a huge difference. Trump's going to it, and Biden did during the midterm elections with him 4 years ago, and Trump's doing the same thing now. And I think after these elections, they're finished. I think the price goes way up. I think that we're just hammering whatever we can down right now, and I think we're kind of backing off a cliff. And I think that once the elections are over, I think we just go off. I think it's kind of like the champagne bottle. I mean, we're shaking it, and because with the type of production that we have around the world and all the facilities and the way that people are hurt, I just don't see how. I don't see how we have the inventories or the supplies to really take over what we have right now. So I can see that. I mean, the total commercial petroleum inventories, excluding the SPR, rose only about 2 million barrels. So it's not like we're flush. We use 20 million barrels a day. How they account for 2 million, I have no idea. But our strategic reserves also declined. They'll find out too when they get down into those strategic reserves. I bet 20-30% of that, those barrels that they use are slush, or they have that stuff in the bottom of it that you're not going to be able to use. I forget what we called that. I think it's a whatever that is at the top of an oil tank. What is that, Mark? Do you remember what that is?
Emulsion?
Yeah,
I don't know what you're.
Yeah, my dad used to clean those when he was growing up, and clean the bottom of oil tanks. You know, when they go all the way down to zero, and you have the oil sitting at the bottom, and if it sits there for a month or 2 months or so, I mean, it just gets to that, whatever you call it. I can't remember what it is, but anyway, doesn't matter. We just don't have the type of inventory we need to. And I think that this. A lot of this is politically motivated right now, and I think that's the reason why prices are down. If you really looked at the numbers and you could put numbers to it, 100%, which be pretty smart because there's a lot of factors. I think the price should be a lot higher right now.
Yeah, very interesting. I want to switch over to Mark. Mark, in the world of geology, as we're kind of talking about supply and demand, and Jay mentioning, of course, still a lot of demand that we foresee in the future, and also, looking at oil, crude, natural gas. What do you think with growing demand? What are geologists kind of evaluating right now? I know that's a very broad question, Mark.
Well, it is, but the difference between exploring for natural gas and oil, there's one fundamental difference, and that is we have to have some way to get the gas from where we produce it from the ground to where it can be consumed. In other words, we have to have a pipeline, we have to have infrastructure. And that makes a big difference. With oil, we can truck it away, but really can't truck away natural gas. People have tried to find ways of doing it. It's just not efficient, not economic. So everything with natural gas requires us to understand the full stream, not only where to find it and produce it, but also how we're going to market it. We have a field in Pennsylvania that we think has 2 TCF of gas in it. And the reason we didn't drill it in my prior employment was because we just had no way of marketing the gas. And so that's a challenge. As far as exploring for natural gas versus oil, I think in the United States, and there's different ways we recover natural gas. Sometimes the old ways were to drill vertical wells in offshore fields, along salt domes, and we would recover natural gas that way. But these days, most of the natural gas is being produced in horizontal wells. It's a lot easier to find natural gas in a horizontal well because the places where it's deposited are over broad areas. And when you find it, you can develop it. It's very consistent because of the way it's deposited. And it's a natural gas is a product that will find plenty of supplies in the future. Still need it, and it's still valuable, but it's a full marketing. One of the things in 1978, when I first got in the oil business, I went to work with Conoco. And at the time, the federal government was concerned about natural gas supplies and was regulating who could use it and was trying to manage it. I've forgotten what that act was called, but the basic consensus was, well, we're running out of natural gas. We better make sure we can provide where it's most needed. And of course, the sad thing is that we were never running out of natural gas. We just weren't developing it quickly enough and putting it in the pipeline. And since that time, we have more natural gas now than we did at that by many factors. So I don't know if that was what you're looking for, Rachel, but that's what I got.
Yeah, no, of course. Of course, that is it's very interesting how just being able to move natural gas is much more challenging. And I know, Bill, we've talked about this before, and maybe you can kind of just touch on this again about how when you're evaluating an area that we want to work in or drill, and I believe it's one of the top priorities that you're looking at is infrastructure. Can you move what you get out of the ground in and out?
Hey, Rachel, you're exactly right. And Mark hit on it a little bit. And I'm going to refer to the Marcellus here for just a minute. The Marcellus is located in New York, Pennsylvania, Ohio, and West Virginia. And gas has been produced up there for decades, since back in the early 1900s. And when it was determined that you could produce a lot of gas in the Marcellus, people jumped on the bandwagon. And what we found out is there are a lot of pipelines in the Northeast. However, those pipelines are designed to produce gas from wells that produce maybe 50 MCF a day, and you cannot take a Marcellus well that's high pressure and is going to flow, say, 2 to 5 million cubic feet a day. You'd blow up the lines. So you had to go in and build new trunk lines. That was time consuming and challenging. And then when you got into acreage up in the state of New York, there was a moratorium on building pipelines and fracking wells. So the farmers in New York looked across the state line and saw their neighbors with new pickups, new barns, new tractors, because you could do all those good things and develop the minerals underneath the land. In places within Texas, the pipeline infrastructure has been very, very challenging. In fact, there are places in the Midland Basin where companies are having to pay $4 to $5 a thousand cubic feet. They're having to pay that to have somebody come take their gas. So they're not only losing money on the value of gas, they're losing double that getting somebody to take it, because you can't, an oil well or a well that produces oil and gas, you can't shut off the gas spigot. It comes out with oil in one stream. So it's separated at the surface, and it makes it much more difficult to to sell the gas, because there's so much gas produced in the Midland Basin that there's no way to get it out. So that will ultimately resolve itself, and is being done so. There are some major pipelines being built from the Midland Basin to the Gulf Coast. A lot of that gas will go to LNG tankers after it goes through an LNG facility. There's several in Galveston area and down in Corpus Christi in the Gulf Coast, and a lot of that gas goes all over the world. In our Bivins project, it's a 60,000 acre footprint, and there's not that many gas lines that go through it. There are some, but it's been a challenging effort that we are resolving quickly, we hope. So we've been spending a lot of time on infrastructure to not only get the gas out, but to make money doing it. And one last little note on that, since there's so few lines in the area, and the gas processing facilities are limited. Once we are hooked up with those, and like I say, we're working on that as we speak, we will not have to pay for somebody to come and take our gas. They'll be paying us like it is in the normal scenario.
Yeah, that's, I mean, what else, Bill, maybe in Bivins, from a land and business development perspective, of course you're working on the infrastructure, the gas pipeline. What other things kind of, make the project optimistic for you guys?
Well, I can tell you that the Bivins Ranch that we have access to is 60,000 acres. They have much more acreage in the area. And what it does is, since there's basically just one surface owner, that allows you to plan for and scale your the number of wells you drill, the drilling pads, the surface footprint it takes up, by doing the large scale programs, you can contract with a few number of contractors, whether it's a rig or a frac crew, and tell them that, look, we've got 8 wells or 10 wells, 12 wells we're going to drill next year with one rig. And you may and probably will get a better, a more discounted rate on drilling rigs and frac crews, casing that you have to buy. It's just economies of scale. And we actually had an intern working here today, a young man that had not been in the business, and even he could recognize that when he buys a 6-pack of beer at the 7-Eleven versus a case, per beer the case is cheaper. Well, that's just common sense. And it's the same thing with the oil and gas industry. It's the same thing with Ford and GM. The more cars they make, it's cheaper for them per unit to make those. Well, the oil and gas business in the field is no difference. It also allows us to budget for and plan where we're going next. For example, in Bivins Ranch, we're looking at our 3rd drilling pad, and we've already got a pretty good idea where pad number 4, 5, and 6 are going, and all those pads will have more than one well on it. Right now, we're having 2 wells per pad. It may wind up in areas where there's a terrain challenge that we may have 4 wells per pad. Over in the Fort Worth Basin, where the Barnett Shale is, there are drilling pads that have anywhere from 8 to 22 wells on a single pad. So
Wow.
the economies of scale and economics far exceeds that of drilling 1 well per pad.
Mm-hmm. Wow. No, Mark, so let's talk a little bit, and you and me have done quite a bit on the geology of Bivins, but I just want to, kind of go back, touch on that, talk about maybe from a geological perspective, what with the existing wells and, some of the current data, what's it taught you? What are you most interested in kind of learning or seeing next on the upcoming wells?
Sure, Rachel. Well, first off, the thing we keep emphasizing on the Bivins project is that it's an existing oil and gas field. The state of Texas recognizes it as the Bivins LIT Canyon Lime oil and gas field. And so that means that we're drilling wells in a place where we know there's hydrocarbon. And our challenge there is to try to maximize it by drilling it the most efficient way possible. It's a package of rocks. It can be as thick as 600 feet. And it matters where in that 600 feet we drill and land the well. And I think we've talked about our experience in the Bakken and how we learned that drilling into the rock that didn't have any reservoir, there weren't a lot of pores in it. It was a brittle dolomitic rock, no pores. It had great source rock above and below it. And what we found is you want to drill in that and frack that, because that's how you create your most effective fracture network. Well, we're using the same technology at Bivins, and we're landing in the intervals that have more carbonates, and they're more frackable rocks, not the ones where the oil and gas was generated. So we're not drilling into the shales per se, we're drilling above them and below them, and we're creating a network of fractures and recovering the hydrocarbon. And one of the things we're going to be doing as far as new learning is we've only landed in what we call the middle target so far. And we've landed that in the first 3 wells we've drilled, had outcome 2 great wells to date that are producing and 1 that was waiting to be producing. And the next well that we drill, one of the next 2 wells we drill, we're actually going to drill into what we call the Upper Canyon Lime. And what that'll do for us, when that is proven successful, is we'll be able to stack the pays. And you talk about drilling multiple wells off a single pad. That's a beautiful situation. That's what's really famous in the Permian Basin for, they call it wine racking. Some people tell me they don't like that term, but I think it's a great one because we can lay those horizontals in just like wine bottles in a wine rack, and we'll be able to recover more oil and gas, as Bill said, from an efficiency of using single pads and completing the wells off that single pad and hooking them up off that pad. The other thing I was going to add, Bill talked about our production in Bivins, but one of the things that makes it attractive is that it's a high BTU gas. It has a lot of liquids in it. And so it gives us a much better value than if we were just selling dry gas, where dry gas might sell for $2 or $3 an MCF. We get an uplift of 45 to 50 cents, depending on the circumstances, on each MCF we sell. So our primary product there is oil, but the natural gas that we produce is really valuable also.
And Mark, just real quick, before we jump in and just end with a couple comments about MidCon, what are some of those different gases that you're actually able to separate from the nat gas you're actually getting out of the ground?
Well, methane is C1. That's our primary product, but we're looking for propane and ethane. And to be honest with you, I'm not a geochemist, so I can't tell you all the C1s through C5s.
Come on, Mark.
Well, right now, you caught me by surprise. I would have had that, but anyway. Because actually it's interesting, and one of the problems in the Marcellus was we had a hard time getting rid of ethane. And that was because it's sort of what Bill was talking about. We had people that could take the methane, but ethane, they didn't want that much ethane in their system. And so we had to find producers. And ethane was very valuable, but it was used for plastics manufacturing, and you had to separate it and sell it separately. So it's part of the marketing strategy. I wanted to add a little thing. I think this is funny. Bill and I both worked in the Marcellus. We had a private equity company from New York working with us. And I talked about how much easier it is to find natural gas. Well, we were looking at the play, and they asked me, well, what kind of area do you think is prospective? And I said, well, it probably covers 90,000 square miles. And I said, but we've got a technique of looking for the best parts. And I think we can narrow it down to 30,000 square miles. And everybody thought, well, that was pretty funny, but that was a fact. There were certain parts of the play that were more prospective than others. And even though the other 60,000 acres could produce gas, it wasn't going to be as attractive or as commercially viable as that 30,000 square miles. I'm sorry. That's a big area. And so I just thought it'd be a good joke for everybody anyway.
Well, that is actually huge, and the Marcellus is a very fascinating reserve to me. You listed how many states, Bill, that it runs through? It's like 5?
Yes, and in New York, they wouldn't let you drill and complete a Marcellus well, nor would they allow you to lay up a big pipeline. And of course, the city of New York, that we all know and love, complains about at times not having enough gas, natural gas, to heat the city in the winter, and yet there's a ton of it right under their feet. Wow. And they can't touch it. Then you go down and you look in Pennsylvania, West Virginia, Ohio, and especially in northwestern West Virginia, one of the best Marcellus wells we drilled was in just north of Charleston, West Virginia, the state capital.
Man, that's state to state in the U.S. is sometimes like country to country, it feels like, but 50 states. So real quick, because I know we're actually a little bit over time, just want to kind of grab a following comment about maybe an update on MidCon. We've got 4 wells being drilled. Maybe Bill, are we coming up on number 5? How are we looking out there?
Well, we've got locations that where title has not been cleared on them. We have roughly, I would guess, 8,000 acres. And Aaron Ledyard, our land manager, who works closely, we all work close together, is quickly adding acreage to that. And the big difference is the difference, say, between the acreage that we're leasing in Ochiltree County versus our Bivins Ranch over in Potter County, just north of Amarillo, is Potter County, our Bivins lease is one lease. The acreage that we're leasing in Ochiltree County are anywhere from, say, 40 acres a lease to a 640. The average is probably 320 acres, and that 320 acres is not owned by one party. We just closed a tract that is 320 acres, one mineral owner, but the tract adjoining that has as many as probably 30 mineral owners, and about that many working interest owners in the tract. So it's way different than leasing a big one owner type tract. Takes a lot more time, takes a lot more people to run their title and the county records. You just can't push a button at the county level and it says who owns all that. You have to do the research yourself on every single tract.
Yeah, and Aaron's been doing a great job. Aaron's been doing a great job.
Without Aaron, Rachel, we would not have what we have.
That's amazing. Okay, Mark, real quick, favorite part of the geology up in Ochiltree County area where we're drilling?
Well, I love the Cleveland sand. That's a broad spread sandstone that produces, and it's a much easier reservoir to produce from. But we find we have at least 3 targets we're looking at there, Rachel. One is called the Oswego. It's a lower zone. It's a carbonate, has some great reserves. The porosity prediction there is a little trickier because you got to find the sweet spots, the best spots to drill, which we have done. There's also a Marmonton 2 horizon, which is above that and below the Cleveland sand. The Marmonton 2, again, we found a place with our consulting expert out of Amarillo, who really knows this area, has worked this same area for 40 years, and he put us onto a place where there's a lot of horizontal production, and so we're offsetting that and drilling those wells. The Haley well, which we drilled, is offsetting an excellent horizontal well, and so we have high hopes for that. So we're getting ready we fracked the first well at the Haley, and we're going to be flowing that back in, I don't know, 3 weeks maybe, and fracking the second well. And we're just getting the engine running now, and pretty soon we'll have all sorts of things coming down the pipe.
Yes,
Literally.
we do. We're very excited about that. I know, Jay, you still with me? Because got a big month. August is a big month for us.
It really is, Rachel, and I'm so fortunate to be here today and where we are because of the team we've assembled. I mean, we're talking to a couple of guys here that are mostly concentrated on Bivins, and Bill's with the land, and he's with the Bivins family a lot, and Mark's also knows a lot about Ochiltree, but he's mostly concerned or drilling and looking at specifics on the drilling of Bivins. So we have Phil Moore, who you mentioned, and also Aaron Ledyard. Phil's the geologist who's been up there for 50 years. I think he's been up there. I think he's 80 years old now. I can't believe he's 80, but he's been up there
Bill?
50. Phil Moore.
Bill is 80?
No, not
Phil
Bill.
Moore.
Phil Moore. I don't know if you've met Phil or not, Rachel. He's come in the office a couple of times.
I feel like I met him. I did meet him once, I think.
Yeah.
I didn't think he was 80, but
He is.
you know,
he
those
looks
geologists, they always stay really young and fresh.
Oh, yeah.
and sexy.
Yeah,
and
I know
sexy.
you're
You got to throw it
lying
in there
now.
too. No.
Okay.
But anyway, Phil has, and he's worked up there for an incredible. So our goal this year is to drill, 12 wells in Ochiltree County and that surrounding area, and drill 3 wells or get 2 more wells drilled in Bivins. That's $100 million this year, and then we'll grow next year to $250 million by drilling 8 wells in Bivins and 24 wells in the Mid-Con. So it takes a good team of people to do that. And that's what I'm saying. We're really extremely fortunate to have Kelly Duncan, who's been on your show a lot here, talking about the projects and talking about, he's the driller. He's the guy that I'm on the phone with him every morning, 8 a.m., 7 days a week. We take off Sundays sometimes, most of the time when there's nothing going on. But we talk 7 days a week with Steve and our field guys at 8 a.m. every morning just to get an update. What's going on? Any troubles? What's some good things? But right now we're getting ready to put, the Haley well online. We'll follow it up with the Odell well online, the Prescott well online, the Thurman well, the Bivins number 3 well, and then that the McLarty. Yeah, like I'm Irish or something. But the McLarty well, which we are moving the rig over right now, that'll double our production at King Operating, if not more than that. Just those few wells right there. And then we're going to continue on drilling the 2 new Bivins wells this year, and we'll drill 5 to 6 more Midcon wells this year, all because of very fortunate to have some great partners that believe in us, that say, hey, you know what, I'm here. I want you to we like that return of investment dollar. We like that write-off. They like the monthly income while we scale the investment, for sale at the end of the year. But I'm very fortunate to have the money in place today. We have great assets, I guess, with Bivins and Midcon, and great team. I mean, it takes – Ken Hirsch said, who built, a tremendous lot of organizations, he said, you know what? He goes, you can have a mediocre asset and a great team, and he said you'll make some money. You can have a mediocre asset or even a great asset with a bad team, you'll fail. Oil and gas is not easy. You have to have the experience, and we're very fortunate here to have some great experience with all the gray hair around here. We do definitely have some experience, and we're excited about the opportunity. And that's it. But I mean, we're putting wells online right now, and we're fortunate to be able to do so.
Absolutely, Jay. So if you've been watching us again today, make sure you put a comment below and hit like, and then go over and go to kingoperating.com, fill out that learn more, and we'll share with you exactly how we are providing such great value for our partners and our investors, and what's coming up on the horizon as far as the new wells going in, how it may benefit your portfolio, maybe your overall tax planning strategy and situation. So we would love to connect with you and share more. And we'll see you back here next Wednesday, same time, for the Oil and Gas Rundown Live. Gentlemen, thank you so much for joining me today.
Great. Thanks, Rachel. Great job.
All right, everybody. Bye-bye.
Thank you.